Hi, everyone. My name is Jeff Prazen with Interactive Brokers. It's my pleasure to welcome back Market Chameleons, Dimitri Pragmatic, and Will McBride. Hey, guys, how are you?
Jeff. Good. Thanks, Jeff, for having us.
Always a pleasure. Always good to see you guys. Happy summer. And as usual, I'm excited to hear this webinar. What are you guys going to talk about today?
So we're going to do the webinar on advanced option strategies. But before we do that, let me just scroll down really quickly to the disclaimer and give you guys a chance. Oops, there it is. Chance to read it. And while we have that up, just as a note, we're going to go through a slide talking about the advanced option strategies, and then after the slide, we're going to go to a website and do some actual examples of advanced option strategies, and then the last 20 minutes of the webinar, we're going to leave open for questions. And if you do have a question that might be related to something that we are currently talking about, and if you ask it, Will, let me know. Will's watching it. He'll read them, stop me, and ask that question. That question, right? And if it's a general question, we're going to leave that open for the last 20 minutes.
D, just so the people know, because I know I get the question right away. What website will you be going to?
Right. So we're going to use the marketchameleon.com website, which is that's the website Will and I own. But we're going to use the options chain, and we're going to run some payout diagrams on the website to show you guys, from the time you construct the strategy, how do you run an options profit calculator, and then we're going to talk about the use cases of the strategies, and then look at the potential profits and losses of the strategies.
Good. Another question I know we're going to get, Jeff, is where, if people have to leave early or weren't able to get on, where do they get a copy of this?
Yeah, it's a great question. I was actually just going to bring that up. So everyone who's signed up for this webinar will receive a recorded copy in their inbox later today. So whether they attended or not, if they sign up, they'll receive it. So if they have to leave early or whatever, they'll get a link to it. Also on our website, you can go into hit the education tab in the upper right hand corner of any page and go to webinars. You can search by content. You can search by contributors such as Market Chameleon, and you can find this webinar as well as I think we calculated last time. Is this like your 26th or 27th webinar with us?
Actually, I think it's the 28th webinar.
28th,
and
yeah,
I think we've done 3 or 4 podcasts, maybe 5.
Yeah, I think about 5 podcasts, and that's where all the material is located too, as far as our podcast with Dimitri and Will as well. So anyone who wants to hear this that didn't sign up, they'll get an email, or if they did sign up, they'll get an email, and if not, they can always go to our education area of our website and listen to this as well as any other webinar. But on that, I will turn it over to you guys, and I'm looking forward to this webinar.
Thanks for having us again, Jeff.
Thanks, Jeff. So with the advanced option strategies, what we want to do is dive deeper into these strategies. Sometimes they call them complex options trades, and typically it's a spread, straddle, iron condor, or butterfly. These are the most common ones. You've heard these names, but they don't have to be this specific strategy. It could be a custom-made strategy. And what we're going to do is kind of discuss their uses, their risks, and potential rewards in some examples. And when we talk about advanced option strategies or complex orders, I wanted to mention that why are they so important? Why are spreads important? Iron condors, butterflies. And when you start trading, and just like when I started trading, you kind of think of trading as simply buying and then selling a single security, right? But trading doesn't really work that way. Maybe investing does, when you buy and hold and wait for something to go up. But trading is a little bit different. And when I think of trading, it's the way you're combining your buy and sell orders. And when you do that, then you can meet certain objectives, right? So if you're a good trader, then you could meet certain objectives that are much more focused, reducing your risk and 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 narrowing it down to a certain exposure you want. And that lets you capitalize on other unique market opportunities that are hidden there and not simply, right in front of you. And if I had to compare it to an analogy, if you think of playing a piano, you could hit a key, and there are a lot of different keys that you could hit. But if you sit there and just hit a key, anybody could do that, but it doesn't really sound good. But if you combine the keys and the right strokes, then you can make beautiful music. And that's how I kind of think of trading, is when you start to combine things and do them in a way that is structured and more focused, then you start really capitalizing on trading. So I'm going to show you some examples, and I think through examples, it's probably the best way to understand the point. And what we could do first is a simple thing is creating a synthetic stock. And a synthetic stock is trying to compare the actual stock price, right? So a stock price is something we could observe. We know Apple's stock price, we know, IBM stock price, and then we could compare that to, well, what is the synthetic stock price? And the synthetic stock price is when you buy a call and sell a put on the same strike and the same expiration, what you do is create the same risk profile of a stock. Okay, and then we could look at the two and see, well, which one's better, and that could create certain types of opportunities that you may have not even thought about before. One is you could potentially get a synthetic for a discounted price than the spot price, which allows you then to basically have the same risk exposure, but at a better price, which is more efficient, right? Why wouldn't you want to buy a stock that is trading at $100 if you could buy it for $99? Well, that's a better price, and why wouldn't you want to do that? Or you could create another opportunity by taking that synthetic and then hedging it with stock, and then all of a sudden you took that position, and you could see as I'm combining different things of buying a call, selling a put, selling a stock, all of a sudden I took off lots of different risks. I no longer have my directional risk because it's hedged off. I don't have my gamma, vega, theta risk, and I've reduced it to the cost of carry. And we'll go through an example of that, but at that point, it's going to be an interest rate play, the difference between where I could lend and borrow, okay? So keep that in mind, that this is all created and structured by a combination of buying and selling different securities, okay, that are out there. What about option spreads? So there are different types of option spreads. There's a vertical spread, which is like a call spread or a put spread. We have horizontal spreads. These are time spreads. So these are spreads that are looking at buying a longer dated options or selling a shorter dated option, or vice versa. And then we have diagonal spreads, where you could do a combination where you're doing different strikes and different expirations. And when you do these spreads, you could structure them in a way where it could be trying to capitalize on a bullish or bearish outlook, or you could do it in a way where you're observing a difference in implied volatilities on different contracts, and you try to capitalize on the different implied volatilities. Okay, so that's the opportunities you would be looking for. Maybe an implied volatility skew that has moved in a way that you think has either gone too far apart, or you could structure a directional play. And when you do it in this structured manner, Well, you could reduce other exposures, right? So you could take and potentially increase the return on the amount at risk. Okay, so even if you have a bullish outlook, you could use options as leverage to potentially get a higher return for the amount at risk and reduce other exposures, such as your Vega, Gamma, and Theta, right? Because when you just buy a call, not only do you have like a directional risk, but you got your Theta risk, your Gamma risk, your Vega risk. How do you reduce that but still maintain a bullish leveraged bet? What about an option straddle? So this is a different type of strategy, and the idea behind it is that what you want to do is take off the directional risk. You don't have a bias towards the stock going up. You don't have the bias towards the stock going down, but you may be interested in the volatility. What are the markets implying the volatility versus your own volatility outlook? You might be looking just at the magnitude of the move, and also you might be looking to take advantage of time decay. So you don't have a directional risk, but you think that there's time decay that you could benefit from, and you might look at a straddle. So that are the benefits, that you're removing a certain type of risk to narrow down on certain exposure that you want by combining different securities, right? And in this case, you're either buying a call and buying a put, or you're selling a call and selling a put, all right, at the money. So let's go down one more. And what about an iron condor and butterfly? So these are strategies that you actually use 4 different legs, okay? And not the ones we've been talking about are usually 2 legs, buying one, selling one, or buying one, buying one. These are 4 different legs, and similar to maybe a straddle or strangle, what this does is use more legs to kind of convert it to a sideways trade. Maybe you don't have a specific bearish or bullish outlook on the stock, and you don't think that you have a big volatility, but you think that something is going to trade either in a certain range or is going to trade outside that range. So now you're narrowing it down to a range-bound trade, okay? And when you use these types of strategies, while you're reducing even more exposure because you're taking off some of those option Greek risks, such as your Theta and Gamma and Vega, by doing an iron condor or butterfly strategy. All right. So with all these, having said all that, it's still important, that you learn risk management and have risk management tools in your advanced option strategies. For example, if you do try to maintain certain exposure, you might want to learn about hedging techniques. So you could hedge to protect your positions, but you could also hedge, for example, your deltas versus your gamma to maintain a delta neutral position and hold your risk to that Vega, okay? Also, when we look at risk, a lot of times, I hear people thinking about risk as something that they're managing after putting on a trade. But there's also risk management prior to the trade. You should know ahead of the trade, even before you enter it, what is the risk reward ratio of this trade? Is there something I could do while putting on this trade to reduce that risk, maybe another leg or so forth as a combination? And it's also important when you get into complex trading, you have these positions to avoid common pitfalls. And some of them, for example, that I see is that, you have an early exercise. So any type of leg you have, depending where the stock ends up in expiration, depending on, if the stock pays dividends, if it's deep in the money, there are other types of risks that you have to understand when you're trading complex trades that could break up the trade, and you have to take that into account. Okay. For example, even if you do when you do a time spread, right? So at some point, one option will expire, the other one will remain. So it'll either expire worthless or be converted to stock. If the stock closes in between strikes, and one strike can get assigned, the other one expires worthless. So these are things that you have to understand going into it. And lastly, when we'll take some real life examples today, but always try to learn from past trades. So from experience, whatever you do, good ones and bad ones, it's important to take lessons, because that's how you get better in anything. And before you put on a trade, the good thing is that you can analyze the trade like we were going to do today, and you can make adjustments to it to optimize it to your unique outlook. So using an options profit calculator, payout diagram, we could tweak it depending on what our outlook is to optimize that strategy. All right, so at this point, well, I'm going to go and show some real life, examples from the Market Chameleon.
Perfect.
Okay. So let me start out with an example of a synthetic stock. So I picked AMC right before, I did screen out where there are synthetic long stock opportunities based on, a discount to the spot price, the cash markets. And AMC came up. So let's see how that would look. AMC was trading $5.05. Here it is, $5.05. And this is the options chain today. And I went out till September 15th, 2023. So you can see here, this is the options chain with 27 trading days to go. And let's assume that my outlook on AMC is that between now and September 15th, expiration on September 15th, my outlook is bullish. I think that we have to go under assumption, right? What risk exposure do we want? And I'm bullish on it. I think it will go higher. And I see that the stock right now is trading at $5.05. So I can buy that for $5.05 and sit on the stock, right? And hold on to it. That is one option, but is that the most efficient way to take on a long strategy in AMC? That's the question. Is there a better way? Can I earn more can I squeeze more out of this trade than just simply buying the stock for $5.05? What else? What other options are there that exist that I could get the same risk exposure, but can I get it at a discount? That's the question. So let's look at the synthetic. So the first thing is we could just take a look at the synthetic and say, okay, well, if I buy a call, let's say here's the $5 strike. Well, if I buy a call and it's 83 cents now, well, I know that the stock has to go above 583, right, at expiration for this call to be in the money and to be profitable. But I could also sell the put at the same time for $1.77. I'll collect it. And of course, if the stock goes down, that put will be in the money and it'll act like stock on the way down. But if the stock goes up, My call will be in the money and it will act like stock on the way up. So let's see what that looks like. So I'm gonna set this up buying this call for 83 cents. Okay. So you can see here buying September 15th, September 15th, 5 call for 83 cents. And then I'm gonna sell this. And by the way, I'm not telling you guys to do it. I'm just showing you as an example of it in an alternative way. All right, just to preface that. But September 5th, I'm going to sell the put for $1.77. Okay, so look at these two legs. Buying the 5 call, selling the 5 strike call on September 15th. And let me run that calculator and show you what that looks like. So this is what it looks like at expiration, right? These are the stock prices, right, at expiration, and this is the payout. Okay, so if the stock goes down, you start losing. If the stock goes up, it will behave just like buying the stock 1-for-1. That's what the line looks like. It's a synthetic, and the stock is right here at 505. Right, so there's the stock, $5.05. That's the straight line. So what do we see here? Well, for the strategy, we collected 94 cents, right? Because we bought the call for 83 cents, sold the put for 177. We collected 94 cents. So if the stock closes right at 505, right? Let's say the stock does close 505. Well, if we bought it at the spot price and September 15th, it closes at 505. Well, what is our profit and loss? It's 0, right? It's at exactly the same price as we bought it. But what about this strategy? Well, if it closes at 505, well, this 5 call is in the money by 5 cents, right? So I own the call. This call becomes an automatic assignment. So I'll buy the stock at $5 and it'll be at 505. This put is out of the money, it'll become worthless. So what I'll do is I'll end up buying the stock for $5, right? But I received 94 cents credit originally. So if you're buying the stock at $5 plus you received 94 cents, in actuality, you're buying the stock down here, right? You're buying it at a discount for $5 at $5. You're buying it for 94 cents below $5 for $4.06. So this actually presents you with an opportunity to have the same risk profile, but at a pretty significant discount to spot price. And in addition to that, well, what else happened here? Well, for you to buy AMC for $5, well, you have to take money out of the bank that you might be getting, 5% interest, let's say, right? Maybe you have it in the treasury, and you have to take that out of the bank and purchase the stock. Well, the stock doesn't pay you interest, right? So you buy for 505. If the stock is at 505 a month from now, that's all it's worth, right? If you sell it, that's all you get. So in addition to that, you continue to earn interest on the cash if you have it in an interest-bearing security, right? So this is one way to be a more efficient trader by combining different options, buying and selling, to recreate something synthetic. Okay, does everybody see that? Hopefully. So if no questions, well, I'm gonna keep moving on if there's no particular questions on this.
Not on this. There were some general questions that we can get to at the end.
Okay. All right. So let me go to a different stock now. Let's use Apple. Right. Or let me use Tesla for now. Since Tesla doesn't pay a dividend, it'll be easier to show it on here. So what if we tried it on Tesla, right? What if we tried it on Tesla? And I came out to, what was it? September 20, something like this. So September 23rd, I'm coming out on Tesla and I'm like, well, let me try that on Tesla, 249. All right, so let's do the 250. Let's say I buy this call for $16.25 and I sell this at $15.45. Okay, so same thing, I'm buying the call on the 250 strike and I'm selling the put on the 250 strike. Let's calculate that. So now I'm paying a debit of 80 cents, right? So I'm paying 80 cents if I buy it on the offer. I'm paying 80 cents above 250, but the stock is 248.87. So here it doesn't work, right? But this is already at a premium. And why is that? You know, why would I want to pay more than 248.87? Well, one of the reasons is that you are going to pay more, right? You're paying over the 248.87, right? You're paying over by whatever dollar, was that 93, something like that. But then you have to make a decision. Well, how much interest am I earning in the bank, right? Because if I'm earning, because remember, I have to move money to buy this from 248.87. I have to move money into my brokerage account, and I have, which means that money is no longer available to buy treasury. It's no longer available to earn any interest because it was used to purchase the stock. So then you have to really calculate, well, how much am I earning in interest versus, you know, how much can I buy it synthetically? Because if you have on your, you know, $248.87, if you're earning, you know, more than what this will cost you, then you're better off doing the synthetic, right? Because you're going to earn that interest. If not, then you might be better off doing just going to the spot price. But what about the other way? Let's go, I'm going to sell the call. I'm going to buy the put, okay? I'm reversing it. Let's actually like this. Let's sell the call, buy the put. I'm doing it on the market prices. So selling the call at 250, buying the put for 1570, we'll calculate it. So you can see here, that's like selling, you're getting 30-cent credit for selling it above 250. So now I'm receiving, right? I'm receiving it. And let's say I hedge it. I don't want this directional risk at all. So I'm going to hedge it by buying 100 shares stock. So look what happened here. I bought the stock versus my synthetic short. They hedged each other off. So look, I don't have any gamma risk, vega risk, hedged off my delta risk. So wherever this stock lands, this looks like $143 profit, or right, $143 profit. So what's my decision here? Because there is an opportunity cost, right? What I did do was buy the stock. And if I buy the stock, that means that all of a sudden I am not earning interest on that cash anymore. So here I have to decide, well, maybe this strategy pays more than I would have earned somewhere else, right? That's the, if I'm holding maybe a bond, and the bond, you know, is in Tesla or whatever, maybe this is a better alternative, and I have to compare the interest rates from now until expiration, right? How much interest am I earning in the bank versus how much can I earn? I know here 143. How much can I earn here on this strategy? And then I can make that decision to see which one is better. So again, what happened here was that we took different securities, buying and selling them, and look what we constructed. We basically constructed an interest-bearing security, right? We took out the gamma risk, the vega risk, the directional risk. We turned it into this carry trade, an interest-bearing trade. Okay, that doesn't exist unless we construct it.
Dee, we did
Right,
have a
so
couple questions about this particular trade. Do you want to answer those now or wait till the end?
Yeah, let me answer them now just because I'm going to move on to a different type of strategy. So,
All right.
so let's,
Now this one is I'll ask it because other people mentioned it too, but I think it's going to depend on the brokerage account, but I just wanted you to answer it. How much margin would be required to take this strategy relative to just buying 100 shares?
right, it's a good question, and I would say that it's probably dependent on your brokerage, what your account is approved for. Because there are different types of accounts. There are accounts that are portfolio margin accounts, or accounts that are Reg T. So I don't think there's a blanket statement that I could say like this is how much margin, because two different accounts can have a different margin for the same exact position. So this is something that you probably have to consult your brokerage firm.
All right. The other Tesla is it worth the risk in this Tesla example? The gain, the person saying, is so small that the stock has significant vol where any movement could wipe out the gain of the synthetic trade. That's what he's saying. We hedged off everything. Did we do the stock against it?
Well, right. I mean, I don't know. At one point, he asked us. So here you're hedging off your directional risk, right? Because what's happening here? Let's remove the stock. So in the beginning, what you have is, let me see. So in the beginning, what you have is a synthetic short, right? So yeah, so now you have a short position. If I bought the put, sold the call, here you have a synthetic. That means your outlook with this position is that you want to short it, right? So of course, yeah, you have a little bit of a cushion here above 250, but yeah, just like shorting a stock, if it goes up, you're losing. So to hedge this off further, right, what we did was say, well, we don't want to be long or shorted. What we want to see is what is the cost of carry, what is in this position, okay? What is the interest I could earn on this position if I hedged it off, the directional. So since I have a synthetic short, if I hedge it off with the long position, then now what we did was took it down to the cost of carry. Right now, this is the cost of carry trade. And now that I have a carry trade, now I have to decide, is this carry trade worth it? Right? So you'd still have to do more analysis based on the interest that you're earning versus the interest that you could earn on this carry trade. Sometimes the interest that you're charged on your borrow, right? So sometimes people can borrow at a lower rate and lend it at a higher rate. But the idea here is that you could see that I'm adding to construct a different strategy than we started out. So you could start out with something that looks just like this. here's a selling a call, right? To then selling a call, buying a put. Then it looks like a synthetic stock, synthetic short. And then I hedge that off by buying 100 shares of stock for each call, right? So for each option, and then that's how we got here, right? So even if we go 20% around, it's always the cost of carry at this point. Now, remember, I did say you got to be aware of early exercises. You have to be aware of also, like, if there's a dividend that could impact the early exercise and the cost of carry. So I chose Tesla because it doesn't have a dividend. It's a little bit simpler to explain. With a dividend, this will be a little bit harder because you have to take the dividend into account, and sometimes you don't know the dividend. You have to guess, perhaps, or forecast what the next dividend is if they didn't announce it. But I chose Tesla because it doesn't have a dividend. That made it a little bit simpler. And if you did this strategy and then deep in the money, then one of the legs could become an early exercise as well.
We just had Robert one clarification on why did 100 shares of Tesla flatten the reward curve?
Right. So when you do, let's say, if you sell one call, right? If you just sell one call, well, one option contract represents 100 shares at expiration. So if this one call, if the stock is above 250, let's say the stock is $260. So you're short a call, and that call will get assigned. And when you get assigned, you will be short 100 shares of stock. Okay, so one call option represents 100 shares of stock. So on the call side, we know, all right, at expiration, you need 100 shares of stock if this call is in the money. What about one put? Well, if you're long one put, right, and the stock is below the strike, let's say that the stock is at 240, right? Well, if the stock is at 240, your call expires worthless, but now you have a put that's in the money. So your put gets exercised, and if you exercise a put, one put you're selling 100 shares of stock. So then in either of these situations, you're going to be short 100 shares of stock if the call's in the money or the put's in the money. You have that pin risk. If it's right at 250, then you're not sure because they could both expire worthless, or one could be. But if either one is in the money, the put or the call in this situation, you're going to end up at expiration being short 100 shares of stock. Well, how do you hedge off being short 100 shares of stock? Well, you buy 100 shares of stock, right? So that's why at expiration, the short 100 shares versus the long 100 shares will offset, right? Not that offsets, it goes away. And then you're left with, well, where did I buy the stock versus where did I sell it, right? So where did you sell it, right? Well, you sold it at 250 plus you received 30 cents credit. And where did you buy it? Well, we're assuming that you're buying it right where the stock is at this moment, 248.87. So if you bought the stock at 248.87 and you sold the stock at 250, because that's where your strike is, plus the 30 cents credit, right? That gives you a profit of $143. Okay.
Excellent.
Right. This is why we have you guys probably heard of put call parity, where if you read the Black-Scholes model, Yep. Was there another question regarding?
Sean just asked, does this pay more interest than say T-bills right now? In what situation would you consider making this trade is what he asks.
So that is up to every trader. You know, that's, as a trader, you're right. I'm just showing you ways to construct it and ways to look at it, but by no means am I recommending any of these trades, right? I'm just trying to construct it and show you guys the way that you could evaluate it from the perspective of risk and reward. But as far as that goes, you know, as a trader, everybody has to look at their own situation. But you know, I showed you like AMC, right? AMC, the reason it's at a discount is because you cannot short the stock and make the difference, the spread. So you're carrying that long position. Here, you could do it from both sides, but typically, you know, you would think that it's close to the treasury. Not all, but it doesn't have to be. It's not always the case. But typically, you would think that it would be close, right, to whatever the treasuries are for 30. Well, this is 32 trading days, so you'd have to look out how many calendar days till this September 22nd expiration. But if it's not, that's what could create an opportunity. And by the way, you could create these on any strikes, right? So it doesn't have to be at the money, right? It could be on a 200 strike, right? I could even do it on a 200 strike. There's a 200 strike. Same thing, right? So you can see here, there's a 200 strike. There's where the stock is. If I buy 100 shares, oops, created cost to carry, right? 37 bucks. So it's, you know, this is just, it's a wider market as well on this. But the idea is here that when we're using a combination of buying and selling, right, that's when we're really starting to trade and look at the markets from a completely different perspective.
Yeah, we had Sam just chimed in. He said another option could be buying 100 shares of the stock and selling a higher call strike and buying a lower put strike, turn it into a collar trade.
Yep.
And
Right.
so you could do all those things in here and see how it works out from a profitability.
Exactly, because once you start doing, then your mind is going to start working a lot differently. Well, how else can I construct it? Where else can I spread it off against a different expiration, right? You could do a box spread or a different type of strategy where the stock does not even have to be involved. You could have a long synthetic in one expiration and a short synthetic in a different expiration. But the idea is that you start thinking about trading from a different perspective than just simply buying a security and waiting for it to go up and then selling that security. Okay. What about the if there's no other questions, I could keep going to like a show and a straddle.
All right, perfect.
Right. So a straddle, and I'll probably stop there because I didn't realize we're at 2:45. So straddle takes out the direction, right? So let's say we're at 250, and if I'm buying the call, right? If I buy call, well, I have a directional bias. I need the stock to go up. See, if the stock stays here or goes down, that's not good for me. So I need it to go up above here. And if I just buy a put, it'll be in reverse. But what if I buy both, right? Buy both or sell both, let's say in the buy both. So I'm buying the call, I'm buying the put. Let's recalculate that. Oops, wait a minute. Yep. So you can see here, all of a sudden, it's not a directional bias towards the upside or downside, because it looks like, you know, if it stays here, you know, in this range, well, that's not good for me. No matter if it goes up a little bit or down a little bit, you know, it's a loser. But if it goes down a lot, it becomes a big winner. Or if it goes up a lot, then it will become a big winner. So this is taking away the directional, because if you're looking at the stock and you're saying, I don't have any kind of directional bias or outlook, I just think that the stock is going to move a lot from here. Well, you could combine two different options to reflect that type of risk exposure. And that would be a strategy. So what if this was too much for me? What if I didn't think it was going to go up forever like this, or down for, you know, till zero, but I do think it's going to move, right? So I do think it's going to move, but I want to bring these red areas in, right? I don't think it might be that's too much. So if I want to bring them in, I could sell wings, because I think it's going to move, but not too much further than, you know, down 11%. So I'll sell that wing, the 220, and then I'll go up from 250 to 280, and I'll sell this wing. So look what I did. Four legs to this strategy. Bought that at the monies, sold the wings, and now let's calculate that. So the idea here is that this red area right now, my break evens you see are 280, 220. Those are my break evens. So I'm going to recalculate. So you see now I brought in, now I'm breaking even a 271 around, and 230 around there. So I brought these in, and now my profits are, if it gets outside this range, right? As long as it gets outside this range, anywhere here. So that's converting that straddle to a butterfly. So I'll just, whatever questions you have now at this point, I'll just take them, because we have like 10 minutes left. Will, are you there?
Sorry
Will?
about that. First question is from early on. He asked, Benjamin asked, is there any directional risk involved in strangles? Is it pure vol trade?
So when we do a strangle, right? A strangle would be two out of the monies, right? So let's say at 250, let's just go down to the 220 strike. Let's buy the strike, right? 220, and then let's do the 280. So what happens is that if you're doing nothing, right? What you needed is to move outside that range. See this red area? You needed to move outside that range. You don't care which direction, right? You don't care up or down. You just needed to move outside that red zone, out of that range. Once it moves out of that range, though, right? Once it starts moving, you start having a directional risk, because if the stock's already here at 304, you know, the 300, 320, once it moves out here, well, what happens is that your call is really going to be deep in the money at that point. Your put might be worthless. Well, your expiration put will be worthless. But at this point, you do have directional risk, because if you do nothing and the stock goes back, right, then you're going to lose again. So options, you know, the start of the strategy is, when you do the strangle, is that from this point, You don't care if it goes up or down, right? You just need it to get out of this red zone. But once it does, the options themselves have a delta. They have a gamma, and then they have a delta, and that delta will increase, right? So the delta could start out at 50, and it could go up to 100. And at some point, once if it goes your way, and the stocks, the stock comes to here, well, you're going to have a new position on, right? You're going to have a new delta risk on, a new vega risk, a new gamma potentially. So you're only looking at it at a point in time, but if it's before expiration, right? If it's before expiration and it gets to here, then you will have a new delta, and you're going to have to manage that risk from that point. Okay, so remember, your positions will still have risk as market conditions start to change.
All right. Dan is asking, when you buy, sell multiple calls or puts for the same security and for the same expiration date, do you control the orders they are executed? I guess when you're entering, how are they executed if you're doing them at different times? I mean, I guess that's dependent on the broker and how it flows through, correct? The brokerage platform?
Yeah. So I know in Interactive Brokers, and Jeff, you could correct me if I'm wrong, but in Interactive Brokers, they accept complex orders, and you could construct it, and when you, let's say, a straddle or butterfly, and when you enter in your limit order, then it will execute. If it executes, it's going to execute all legs of the trade. It's not going to, it's not going to execute half of it and say, well, these are the legs you got filled on, not these. As long as you enter it in as a complex order, and it hits your price, then all legs of that order will be filled. They're not going to be left.
Yeah, it would depend on the order type, and without getting too into the weeds with it, but there's guaranteed and non-guaranteed orders. It depends on the number of legs. So there are several factors, Dimitri, included.
Okay.
Obviously, if it's a limit or a market order, it's a slight difference, obviously. So there's other factors go into it. So it really just kind of depends on the combo, I guess, would be my response. Everything is, at least with Interactive Brokers, everything is very clearly marked when the trader puts in an order, so they know exactly what the situation is. And sorry to take time up from you guys, but to go back to the margin question, with Interactive Brokers, the amount that the margin is going to be used, if you're using margin, it clearly marked out to the individual in a pre-trade confirmation window prior to submitting the trade.
Okay. Yep. So there you go. So the good part is, even before you do the trade, you'll be able to assess what the margin of that trade will be prior to entering, right? Prior to entering into the market. Right. And as far as the complex orders, yeah, it's I can't speak for all the brokers, right? You'd have to look, and there probably are, like Jeff said, I'm not thinking of them, but there's different situations that you have to take into account when you're entering them in, because you could put in all or none, right? Which means that it won't get filled unless all of your size, all of your quantity. You could get partial fills, but I think that the legs will still, the different legs still are required they will get filled, I believe. But check with your broker. You should always check with the broker before you do it. All right. Well.
Yep, Jeff. We did have a question. I know you sent him a link. Someone was looking for just like, do you occasionally have webinars for the IBKR platform? He was asking in particular some of the tools Dimitri's using Is there anything like that on the IBKR platform? I don't know how to answer, but I know he's,
Yeah, so I sent, I think his name was Brian. I sent him a couple links to our Traders Academy, but for everyone there, on our website, if you click on the education tab and go to Traders Academy, there's short, let's call it 5 to 8 minute long videos on pretty much all the tools that the Trader Workstation and, you know, and also mobile offer. And there's specific option courses as well. And in the past, I will look for it while I'm talking, but there, we actually did an option tool webinar a few months ago specifically for that. So I'm going to take a look real quick and see if I can find that and send the link to everyone in the.
yeah, Brian, if you're missing it, Rudolph just typed in at the end. He said IBKR has a cool tool called Strategy Builder, which allows you to set up a complex trade quickly. As the position changes, you can then leg into it as needed. It's called Strategy Builder. And
Yeah, that's
there you
located
go.
right on the option chain. That's located right on the option chain. So
Awesome.
All right. Awesome. So I guess, yeah, if there are no more questions, well, we could end it there. We're like right up at almost an hour.
Yep, and we have Jeff on. So Jeff, thanks for, as always, for having us on, my friend. If we do have any, there are a lot of questions sitting out there. If we do have any questions that you feel are unanswered, you can join us. We have a YouTube channel. We do a free pre-market show every day with Dimitri, myself, and a couple chameleons join us every morning, ask questions, help with questions. So it's a really good pre-market show, and that's 9 to 9:30. Just go on YouTube and search for Market Chameleon. It will come up.
Yeah, it was great having you guys. And to everyone, I just put in the link. It was a webinar called Trading Options at Interactive Brokers. Actually aired back on March 7th, but I just sent the link. Anyone can go to that link and download it and watch it. We cover several, myself and our Director of Trading Education, Andrew Wilkinson, we cover several topics too. So that's always a good resource as well as the Traders Academy lessons. But always a pleasure having you, Will and Dimitri on, and looking forward to our next one.
Yeah, awesome. Thanks, Jeff. Thanks everyone for joining. Thanks to Interactive Brokers, and yeah, hope to see you guys next time.
Have a great day, everyone. Thanks, Jeff.
All right, thanks, guys.
Bye, Rick.